Hey everybody, my name is Jonathan Rose. I'm owner of Masters in Trading. I was a market maker for 5 years, Chicago Board Options Exchange. I've been trading since 1997. This weekend, like many of you, I've been listening to podcasts. I've been reading coverage of what's happening in game, and a lot of the thoughtful things that I follow and people that I follow are jumping into this with a conclusion, and I see so many people just completely wrong, just totally missing the story of what's going on with game. So I wanted to jump in. I know there's a lot of polarity out there on this topic. Before I even get started, I fucking love what's going on. I think that the trade in itself was so clever that I have all the respect in the world for it. So, but I want you to understand the trade, because people are saying, you know, this is a movement. What's next? AMC. What's next? Silver. That sounds all well and good, but I think what happened is some really fucking irresponsible hedge funds got really arrogant and didn't think and tried to corner the market. They tried to control the market by going over the actual float that's out there. So what ended up happening were a very smart person and people, and then I got momentum after that, got wind of this and decided to make a play to expose them. This was not a new story. On August 31st, we were playing the game Short Squeeze. Here are my trades. Making $5,000 to $6,000 on the trade, and we're only making money because of the short squeeze. But here's where the genius part comes in. And for that, I want to walk you back or take you back to the original Reddit post to show you exactly what happened. I know a lot of people will read through this and may not understand it, so let's just do it together. This was the original game Reddit post. I'll put this in the video comments as well. Okay? He wants to go after game. This is a trade idea to the group. Okay, isn't game a piece of crap? No. Well, he makes an argument for the company going forward from a fundamental standpoint, but also because of the short interest. This is what we're going to focus on. Now, the rest of it, absolutely brilliant. I mean, it's such a cool trade, but I want to go through this because I'm not sure there's a next stock that everybody could go after. The reason game got exposed is because of the math. So here we go. When they wrote this, game currently has between 85% to 100% short interest, depending on what site you use. Shares outstanding of June 2nd, 64.8. Insider shares, 8.9. Public float, shares outstanding minus insider shares is 55.8. Ryan Cohn comes in. He's got 6.2 million. This is the Chewy guy, acquired August 31st. So therefore, the adjusted float is 49.6. Here's why game is doing what it's doing. This is not, let's go into the next stock. Let's pick the next sector. This was a very, very smart trade. For us, and me doing this for a while, when we see something like that, we take advantage of it and made $5,000, fine. But this guy was going after bigger fish. These guys, right? YOLO, that's their mantra. So what he decides to do is, hey, if we could expose this, there's no end to the game run-up. Because what would you possibly do? Let's keep going. And you can read through all this, at your own pace. Here he goes on to make an argument for the fundamentals of the company. Again, very, very smart dude. Fine, great. But this is what I want you to pull your attention to next. Thanks to market makers literally not using their brains and relying on math to configure their entire business, we could take advantage of them sleeping at the wheel. Okay? He's right again here too. Market makers are blindly, oftentimes, making bid and offers on options, keeping them as wide as they can for as much edge as they can. As automated computers come, the markets, the bid and offer for all options orders get squeezed, get tighter and tighter and tighter, Market makers are forced to compete with that. That's very, very difficult. It looks like this. Robinhood call option buying. Market maker delta hedging share purchase, short squeeze, so forth. I'm going to explain this in my own terms. By the way, this is not a pump and dump. This is right. It's not a pump and dump. What this was, or what this is hedge funds thinking they have a backstop, thinking that they can short more shares than there is because the stock's not going to run up to 400 or 500, that somebody will step in. Talks about delta neutral. I want to explain that with the chart. Remember, since GAME is literally 100% afloat short, they currently have less than 50,000 shares in liquidity. Okay, and then he talks about how they're going to do it. And this is awesome. This he nails too. As I'm writing this, delta on average is around 0.2. Higher for near dated. Okay, all this stuff about the timing, this was too early, but he stuck with it. This was all too early. Okay, follow up, read that. What he's saying though. Now look, I'm bringing you to iBorrow. iBorrow is the site that was referenced in the Reddit piece. And this is talking about the short fees, the short exposure. So right now, January 26th, you see that fee? 83.6%, available 1.1 million shares. So what that means is whoever is short is paying an annualized overnight rate of 83.6% to sit short those shares. If somebody is short 100 shares of GAME, they are paying a one night annualized rate of that 83.6%. So 83.6%, just break it out into 1/365th of that. That's what they're paying. And there's 1.1 million shares available to trade. Now, if you think about it, and then you can see the different fee and how the fee is spiking, how many shares are available. But think about it this way. If you're long GAME, if you're long 100 shares of GAME, someone's got to be short 100 shares of GAME, right? The person who's short is paying a fee, an interest rate to be short. That's what this fee is, right? What about the person who's long? The person who's long 100 shares. Does he get that fee? Or is there a middleman that is not paying that long shareholder, but is taking an interest from that short holder to cover the brokerage firm's risk? So that's what's going on. People are holding a massive short position, but it's costing them more and more money. Now, if I take you to the options, here's why GAME's going to trade over 1,000. Unless the SEC steps in, I don't even know how that would possibly work. There are no shares to short, correct? Big hedge funds are holding massive short positions. They're getting charged 83% overnight interest as one day at a time on that short. It's very, very, very expensive. Market makers, and I was a market maker, Chicago Board Options Exchange, don't want to take risk. Market makers want to trade volatility. The implied volatility of the February options of GAME is 650%. Market makers do not want to trade direction. They just want to trade volatility. So with the stock at 325, right here, these, if we were to buy, and these prices are just so outrageously insane. But for every one we buy, one option equals 100 of the underlying contract, right? One option is the equivalent of 100 once it's in the money. So these 325s right here, this delta, 0.75, if I bought one option, it's like buying 3/4 of a stock. 0.75 of 100 shares of stock. So if I buy 100 options, that's going to be the equivalent of 10,000 shares once it's in the money, if the delta was 1. So if I buy 100 of these, the delta is going to be 7,500. So the market maker that sells me these options, even if I just lift this bid here, the market maker that sells me these options, because of the delta, he is now long 7,500 delta. What is he going to do? What does he have to do? In order to get delta neutral and not to care about direction and to only care about trading volatility, like the role of a market maker, he's not speculating. People who think market makers control price, that's far from the truth. So this market maker has to go and say, fuck, I'm short 7,500 shares. I have to buy 7,500 shares. There are more shorts than longs. Who's ever short, the brokerage firm is then going to buy in shares from somebody because that market maker needs to buy shares. So these guys are doing this because they're forcing market makers to buy shares. And that's why if you go way out to the 800s, they're doing it in size. And they're doing it in size over here with significant amounts of capital. I mean, the vol on these, somebody could sell these and they're going to make money as long as we don't get above 700. But the market's pricing these to get over 700 or over 800. If these guys don't give up their shares, which they're not giving up their shares, this stock's not going down. But my argument, and again, I think it's awesome. This was a genius trade. Wow, what a clever dude. But this happened because of this. If you guys try to play this game down here with these, you're going to see these hedge funds destroy you because they're going to put all the money in the world. But even with all the money in the world, they're getting blinded out by the interest rate. There's no stock to short. They're fucked. That's what I think. That's where I think a lot of people are getting the game story wrong. It would be cool if it was a much bigger story, but I think a couple of very, very clever people took advantage of hedge funds that are now being stubborn, but were so audacious to the fact that thinking that nobody could take them down. This was up there. Again, I'm a grinder. I've been in the business for a while. We called this out. Did I ever think this was going to 400? Absolutely not. I've never seen that before. That part was artificial, but it sure makes a ton of sense, and it's not illegal. What's illegal or what's stupid is having more shorts out there than longs. Hope it helps, guys. Jonathan Rose, owner, Masters in Trading.